Okay, let's dive into this really fascinating theory that's been making the rounds. It connects gold, Bitcoin, and the US dollar in a way that suggests a massive shift in the global financial system might be on the horizon. The whole idea is to try and make sense of the markets, which, let's be honest, feel pretty chaotic right now.
So what if all this volatility isn't random noise? What if it's actually part of a deliberate setup? In this explainer, we're going to walk through a framework that sees all this turbulence as a carefully managed lead-up to a major financial reset, a moment where the fundamental rules of the game could be rewritten. Let's see what that might look like.
So, to really get this theory, we first have to look at the immense pressures building up in the global economy. Proponents of this idea say these aren't just random headwinds. They're the necessary ingredients for a major reset.
Now take a look at these market signals. You've got strong gold, a volatile and kind of suppressed Bitcoin, and tech stocks that are really struggling. Well, this is exactly what the theory predicts for this pre-reset phase. They call this the squeeze, where liquidity is being intentionally pulled out of the riskier parts of the market.
So how is this squeeze actually happening? Well, according to the theory, it's these three big forces working together. A strong dollar and high interest rates act like a vacuum, sucking capital away from speculative assets. At the same time, you've got stress in the bond market, which tightens the financial screws even more. And you know when things get shaky geopolitically, big money almost always runs to its old safe haven, gold.
Okay, so the system is clearly under a ton of stress. What's the emergency exit? This brings us right to the heart of the theory itself, a pretty unconventional plan for navigating out of all this financial pressure. This quote just nails the logic of the theory, right? The idea is to methodically drain all that speculative froth from the market before you change the system's foundation. You can almost think of it like carefully deflating a bubble before it pops on its own, uncontrollably.
And this is the crucial point. It's not about choosing gold over Bitcoin or vice versa. It's about a specific sequence of events. The plan, as it's laid out, is to first use gold to fix the old system's problems. Then, once that's done, you use Bitcoin to build the new one.
Now for Act 1, the gold reset. Let's break down how this revaluation is actually supposed to work, because honestly, it's the linchpin of the entire theory.
This question is absolutely central to understanding the mechanics here. I mean, the US has over 260 million ounces of gold, but on its official books, it's valued at a price from back in the 1970s. Why? Well, the answer is a little trip down financial history lane.
Essentially, this official price is just an accounting fiction. It's a relic left over from when you could actually trade your dollars for gold. Keeping it this low avoids some political headaches and kind of helps mask decades of inflation. And this is the key. It also represents a massive, untapped piggy bank on the government's books.
And this just shows you the staggering gap we're talking about. On the left, you've got that dusty old official value. On the right, a potential market value that analysts think could be used in a reevaluation. The difference isn't just big, it's literally measured in trillions of dollars.
So just by changing an accounting entry, remarking its gold to a value closer to, say, $10,000 an ounce, the U.S. Treasury could instantly, like overnight, add $3 to $4 trillion in asset value to its balance sheet. And the most critical part? It could do all of this without printing a single new dollar bill.
Now, you might think a move like this would cause total chaos, but the theory argues it would do the exact opposite. The idea is that this would only be triggered by a really severe shock, like a crisis in the bond market. The revaluation would act like emergency financial surgery, instantly stabilizing the system and restoring global confidence in the U.S. balance sheet.
But what happens after gold stabilizes the ship? What's next? This is where we get to Act 2 of the theory, and it's all about Bitcoin. Not as a competitor to gold, but as its successor.
This sentence just perfectly captures the whole narrative pivot, doesn't it? It draws a really clear line between the roles these two assets are supposed to play. One is for fixing the problems of the past, the other is for building a brand new digital infrastructure for the future.
So you can see this clear division of labor here. Gold is positioned as the anchor. It's backward-looking, it provides that historical credibility and restores confidence. Bitcoin, in this view, is the forward-looking engine. It's the new, dynamic, programmable collateral for a truly digital financial future.
And here's the twist. Once stability is restored by gold, a booming, regulated Bitcoin market actually becomes a huge win for U.S. financial interests, not a threat.
Why? Well, it generates enormous tax revenue, it pulls capital onto U.S. regulated platforms, and it helps the dollar dominate the digital world through stablecoins. Okay, let's put all these pieces together and take a look at the proposed timeline, from the pressures we're feeling today to the potential reset of tomorrow.
The theory lays out this really clear progression. First, you have the setup, which, many would argue is happening right now. Second, there's a crisis point, probably a loss of confidence in government debt that acts as the trigger. And finally, the reset itself, which kicks off a whole new phase of adoption.
This timeline kind of maps the whole thing out for us. We're currently in what it calls the pre-revaluation phase. The theory then projects some kind of crisis trigger around 2026 to 2028, which would force the gold revaluation. And finally, in the post-reset world, the system would enter a new state where Bitcoin's integration could seriously accelerate.
And this is a really important point that proponents make. This isn't viewed as some secret backroom plot. It's seen as a logical, almost unavoidable solution to mounting financial pressure. It's presented as a matter of cold, hard accounting and incentives, not some grand conspiracy.
So at the end of the day, whether this whole framework turns out to be prophetic or not, it gives us a really powerful and coherent way to look at the complex forces shaping our financial world. It connects the dots between gold's ancient role and Bitcoin's potential future, and it leaves us with a pretty critical question to think about as we watch all this unfold.